Section 17.3 deals with calculating financial strength analysis. Basically, we have a business needs to have adequate capital in order for them to succeed and to thrive. When we take a look at it, a business can get capital from two different sources: the owner's investment and retained earnings, or from loans. Capital, either owned or borrowed, is to be used for a long period of time. Some capital is borrowed for short period times. Business can invest in capital in assets, such as equipment and buildings, for long periods of times. Business can also invest in assets, such as merchandise, that will be converted back into cash for a short period of time. When we take a look at our math that we're going to be learning in here, we have the Hamilton Company or Corporation, and they use three measures to analyze short-term financial strength: working capital, current ratio, and the acid test ratio. So we take a look at, first, our working capital. Working capital is the amount of total current assets less total current liabilities. So basically we're just doing some math here. What we have to take a look at is businesses need adequate capital if they intend to expand, develop new products, or offer consumers greater choices. We have to come up with two ways that we're going to get capital. And if you listened before, I said basically that's going to be your owner's investments and retained earnings or loans. So what's the difference between a short-term asset and a long-term asset? Basically, short-term assets are usually consumed or converted into cash within a year. What's an example? Cash, supplies, accounts receivable, and even prepaid insurance. Those are going to be termed your short-term assets. Long-term assets are ones that are going to be used over a longer period of time, including furniture, equipment, building, and land. Working capital is the amount of current assets available to the business after our current liabilities are paid. So let's take a look at mathematically how we do that. So we'll take a look at our current year's assets, $1,254,100. Subtract the current liabilities of $596,100, gives me my total working capital. Okay, let's take a look at what they had the prior year. So the prior year, they still had a lot of current assets, but look at the difference between here and current liabilities. So their working capital was $433,200. So this is a favorable trend for Hamilton because it is going up. We take a look at the reason for prior year's lower working capital was the company's fast expansion. Basically, when companies expand rapidly, it needs to borrow money to buy more inventory and pay more employees. The rate of increased costs for merchandise and payroll may be initially greater than the rate of increase in sales and net income. So that's going to be one of the things that happened with Hamilton. So let's take a look at current ratio. Current ratio is what shows the numeric relationship of current assets to current liabilities. Okay, so we're pretty much using the same type of information we did in our working capital formula, but instead of subtracting, we're going to divide to get our ratio. The first measure in a current ratio is a relationship of current assets to current liabilities. Companies rely on cash on hand plus the cash soon to be received from other current assets to pay our current liabilities. We take a look that a current ratio needs to be 2-to-1 is considered healthy. Industry experience shows that a current ratio can be too high. If a current ratio is 3 to 3.0 times or higher, the business may have more capital invested in the assets than is needed to run the business. So again, our desirable goal is going to be 2-to-1 or 2-to-1. So how do we do that? Okay, current year. So we can see our current year when we divide is going to be 2-to-1. Prior year we have 1.6. Again, we looked back and we saw that the prior year's ratio was lower because of the company's fast expansion. But this year the ratio is looking much better. So here we have our acid test ratio. Well, in order to do our acid test ratio, we have to understand the phrase quick assets. Quick assets are those current assets that are cash that can be quickly turned into cash. Okay, Those include the account cash, accounts receivable, marketable securities, but not merchandise inventory or prepaid expenses, because that you have to do more work in order to get into cash. The other phrase that we need to know in order to do our asset test ratio is what is an asset test ratio. So basically that's a relationship or a ratio that shows a numeric relationship of quick assets to current liabilities. So again, you have to understand what those quick assets are. So total quick assets, and in this case for Hamilton, we're looking at the account cash plus accounts receivable. So current year we had cash of $206,100, total accounts receivable, divide by the current liabilities, and they have an asset test ratio of 1.0. Okay. What did they have the previous year? 1. They had 1.1 this year and 1.0 the previous year. So again, this trend is going up. What does 1.1 mean? It indicates that for every dollar needed to pay current liabilities, Hamilton has $1.10 available in quick assets. The desired industry standard for an asset test ratio is between 0.9 and 1.3. So that's going to give you your rate of where we're at there. So we have our next phrase of taking a look at our long-term financial strength analysis. So previously we looked at our short-term financial strength, but now we have to look at our long-term. Basically, they have to have, to be successful, you need to continue operating through both strong and weak economic periods. Long-term financial strength requires a balance between stockholders' capital and borrowed capital. When we take a look at our business, we're going to take a look at 3 long-term financial strength analysis tools. We're going to look at debt ratio, equity ratio, and equity per share. So here's our first one, debt ratio. This ratio is found by dividing total liabilities by total assets. The meaning of this debt ratio, when we calculate it, we have our total liabilities divided by total assets will give us a debt ratio of 49.1. What does that mean? That for every $1 of assets owned by Hamilton, the company has borrowed 49.1 cents. So for every dollar that they own, they borrowed 49.1 cents. So we have to take a look at last year. The debt ratio has improved considerably over last year. So how could we make this even better? The funds are secured through the sale of additional capital stock could be used, and that would reduce our total amount of liability. So how could we make this year even better? Instead of borrowing money, we could, again, increase the number of investors in our business, and that would then make our total liabilities go down. Our next item that we're going to learn about is going to be equity ratio. This ratio is found by dividing stockholders' equity by the total assets. Okay, it basically shows the percentage of assets that are provided by stockholders' equity. So, let's see, what do we have here for the current year? My numbers didn't come across, I apologize. So the current year we have 1,051,600, and we divide across and we get an equity ratio of 50.9. Prior year we had stockholders' equity of 849,300 divided by our assets, and it gives me a ratio of 48.3. So when we take a look at our ratio of 50.9, that indicates for every dollar of assets owned by the company, 50.9 cents was acquired with stockholders' capital. The average equity ratio for companies similar to our corporation is 57. So therefore, Hamilton's ratio are below the industry average, which is an unfavorable condition. The debt and equity ratio show the mix of capital provided by the capital borrowed and the capital provided by stockholders. Okay, so when we take a look at the sum, they should equal 100. So if you take a look in your example in your book, on page 515, they will show you how your debt ratio and your equity ratio added together will give you 100%. Now, equity per share. I hope you have heard that phrase before, and that's the amount of stockholders' equity belonging to a single share of stock. Hamilton's equity per share for the current year and the prior years are going to be calculated here. So we take their total stockholders' equity, and again the number is out of whack here. For our current year is going to be 17.53. The prior year is going to be 16.99. Basically, we look at this number, it tells our stockholders how much ownership of the company each share represents. We have an increase from 16.99 in the prior year to 17.53. So that is a favorable trend because the amount that the owners have in the business is going to increase. And here are our terms that we're going to be using for section 17.3. So here we have work together 17.3. We are going through and calculating some information from Allied Technology. We have numbers here in the directions from their comparative balance sheet. We're going to calculate the following short-term analysis ratios for the current year and prior year, and we're going to round to the nearest 0.1 or 10th. So we're going to go through and complete these in this order of working capital, current ratio, acid test, debt, equity, and then equity per share. So when we take a look at here, we have to go through and plug in our information. This is going to be our total current assets, subtract our total current liabilities, and that's going to give us our working capital. So for the current year, we have $2,150,000. And our liabilities, $830,000. Okay, so where did we get that number? Here we go, and here we go. So if we subtract using your calculator, get the difference, $1,320,000. Do the same thing for the prior year. So we had assets of $1,900,000. We have total current liabilities of $905,000. So you can see that we have a higher amount of current liabilities. So we're going to have working capital of $995,000 from the prior year. So is this a favorable trend? Yes, it is, because you can see they have more working capital. So the next one we're going to do is we're going to do our current ratio. Our current ratio is calculated by taking your total assets and you're going to divide by your total current liabilities, and that will give you your current ratio. So we're going to be using the same numbers, but instead of subtracting, we are going to divide. When I do that, again, we need to have to the nearest 10th, so that gives us a ratio of 2.6. Prior year, we had $1,900,000. Total current liabilities, $905,000. So here we have 2.1 for our current ratio. So if we think back to what we talked about before, we have to be aware of what our ratios are at to make sure that everything is going to be functioning in a productive manner. When we looked at Hamilton, their ratio was 2.0 was what it needed to be, but different businesses have different ratios, so we can see how the ratios are playing out here for our applied technology. Now we'll go through and calculate our acid test ratio, and that is done by taking our total quick assets. And again, quick assets is going to be like cash and accounts receivable or any market ones that you can turn in to get to cash. And we're going to divide by our total current liabilities, and that will give us our acid test ratio. So notice right here, it gave us our quick assets of cash and accounts receivable of $664,000. Total current liabilities, and that gives us an acid test ratio of 0.8. Prior year, we had a greater amount of quick assets, So therefore, if you would assume if we had greater assets, they're going to have a higher asset touch ratio the prior year than this year. So when we take a look at this, we take a look that for every dollar needed to pay current liabilities for the current year, our Applied Technology only had 80 cents. The prior year, for every dollar needed to pay current liabilities, it had $1.30. So this is an unfavorable trend with the current asset ratio going down. So let's take a look at our debt ratio. Our debt ratio is going to be how we take a look at our long-term financial strength. Okay, so our debt ratio is going to be calculated by taking our total liabilities, and we're going to divide by our total assets. And that's going to be 1,340,000, 3,210,000, and that will give me a debt ratio of 41.7. Do the same thing for the prior year, 1,325,000, 2,960,000. That gives me a debt ratio of 44.8. So when we take a look at our debt ratio, you will recall that if we add together our debt ratio and our equity ratio, those two should give us 100. Okay, so what do these ratios mean? For Applied Technology for the current year, for every $1 of assets that it owned, it had to borrow 41.7 cents. The prior year, for every dollar that of assets owned, they had to borrow 44.8 cents. Okay, so this is going to be a favorable trend because they are going through and they have to borrow. They're borrowing less money for this year. Okay, let's take a look at that equity ratio. And the equity ratio is going to be calculated by taking the total stockholders' equity, and we're going to divide by our total assets. I had the wrong one open. That's why I was having problems. Okay. Total stockholders' equity, total assets will give us our equity ratio. Total stockholders' equity for the year, 1,870,000. Total assets, 3,210,000. When I divide those two, my equity ratio will be 58.3. The prior year's total stockholder equity is 1,635,000. Total assets of 2,960,000 will give me an equity ratio of 55.2. Okay, so this is what I talked about where you can take the two and add together. So when I look at my equity ratio right here, the current year is 58.3. If I add 41.7, my debt ratio and my equity ratio together, that is going to give me 100. Okay, so what does this number represent? For every dollar of assets owned by the company, 58.3 cents was acquired with stockholders' capital. The prior year, for every dollar owned by the company, they had to use 55.2 cents. Okay, it shows the mix of capital provided by the capital borrowed. Okay, so when we take a look at our business increased its number here. So they're going to have to go through and watch how that is going to work. Now let's take a look at our last one of equity per share. That is done by total stockholders' equity dividing by share of stocks outstanding to give me equity per share. So current year stockholders' equity 1,051,600 divided by shares of capital stock outstanding, which is 60,000, is going to give you my earnings per share of 17,053. We're going to do total stockholders' equity here, and for the prior year, which is going to be 849,000. I plugged in the wrong numbers. Sorry, looking at a totally different problem than what we're supposed to do. Let me try that again. Our current year was 1,870,000 plus 120,000 shares of capital stock outstanding, because that's what this example is, not the one I was plugging in. Gives me 15.58. Prior year 1,635,000 divide by 113,000, and that'll give you 14.47. Okay. Basically, we have our equity per share has gone up from 14.47 to 15.58. That tells us how much ownership of the company each share represents. So this value is going up, and that is a favorable trend, something that they would want to continue. So you can see by taking a look at all of these different calculations, it gives us a snapshot of how well the business is doing. We just don't look at our cash account or look at our equity account to find out what's going on. We have to take a look at individual aspects to see how well we're doing. Go ahead and do the on your own. And don't forget, for the test on this chapter, you are going to be able to use a note card to write down these formulas to help you out a little bit. Good luck.